Joining us right now is Kelsey Berro. She is JPMorgan Asset Management fixed income portfolio manager. And Kelsey, I don't know, my take on the commentary afterwards was, it's a hawkish statement, but not as hawkish as I had even expected, is that why the market was up, or do you see some other reason?
Yeah, so it's interesting. You know, we hear what Chair Powell said, but then we watch the market reaction. The market reaction is a function of not just what he says, but how the markets were positioned going into the decision. And what I interpreted the positioning heading into the decision is that markets were prepared for something much more hawkish with much more division. So there were concerns that the number of dissents would not be 3, but 4 or 5, right? And we ended up seeing, I think, a committee that, sure, there's division, but I think in general is still fairly well coordinated in terms of their expectations, which is they want to get policy to neutral, and they don't know exactly where neutral is. There's a range of expectations for neutral. 275 to 375, you could drive a truck through that range, right? But they all kind of generally think policy should be in a certain place, and it's about fine-tuning from here.
And it sounds like they're still data dependent. And by the way, you can call it 3 dissensions, but Stephen Myron, he would have voted for 25 basis points over nothing. So I really look at it as 2 dissents at this point.
Right. And I would agree the Fed remains data dependent. And when I look at the probability of a rate cut for January, which is still around just 25%, you know, I think the risk reward on that is actually pretty interesting.
In terms of, you think the risk is, it's more likely that they go to the upside of that, not below, right?
Correct. Yeah. Because we are heading into a week with 2 very important data points, which are payrolls on Tuesday. We're going to get a combined report of a partial report of October plus November, the lagged impact of the government shutdown, catching up on all those data points we missed, as well as a CPI report on Thursday. And I think the Fed still remains very sensitive to the downside risk to the unemployment picture. And I look at their SEPs, and they see the unemployment rate peaking at 4.5 and coming back down.
SEPs is the dot plot?
Yes, the summary of economic projections. And so if you see any upside to that unemployment rate, because it's basically already at 4.5%, they have space to move rates lower from here.
Torsten Slok had a note he put out this week, just kind of digging around this question we've all been asking. Since the Fed started cutting rates over a year ago, we have seen nothing but the 10-year rate go higher, and that kind of dislocation, especially when you look at the 10-year relative to oil, with oil prices coming down, like just the divergence of things that naturally trade together.
Right.
It's been pretty surprising. Why do you think that is? What's the mystery here?
Well, if you look at yields year to date, Treasury yields are lower. The U.S. is actually one of the better performers in terms of developed market rates. And I would say over the last 3 months, we've really been in a range, a fairly tight range on the 10-year Treasury of between 4 and 4.25. And I think what is keeping us in that range.
But we've cut at the low end. You know, the Fed's cut 175 basis points, even though we've been kind of stuck in the same place for the 10-year.
Right. And I think when you start to dissect, you know, the moves in yields, there's 2 components. There's the real yields, and then there's the inflation expectations. The inflation expectations are what you're talking about, linked to oil. Inflation expectations have actually been very well contained, and they've come down. And what has remained very sticky and high, which has kept longer-term yields high, are real yields, which I think is a signal that markets are testing this idea of higher structural growth, higher productivity, and that's the type of structural story, which is why yields are higher than they once were a couple years ago, despite the fact that the Fed is cutting rates.